finance fees, and then there is an operating lease.
There are internal auditors everywhere, then how did that Vijay Mallya fraud even happen?
Gross profit will give me the sales.
Are internal auditors as independent as external auditors?
Let's think about a bond or a debenture which is not listed on the stock exchange. Okay. So there is bond as in debenture, bond 1 and bond 2. Okay. Can you think of some sort of a company? Let's think of Zepto. Okay. Zepto. And the other one is Swiggy Instamart. Okay. Both of these companies are not listed. Swiggy Instamart. These are all grocery delivery apps. Okay. Swiggy Instamart is a subset of Swiggy. Both of these are grocery delivery apps. What was the third item that we saw? Observable inputs other than prices. Now, we are looking at bonds issued by these two companies. Bonds means that these two companies have borrowed funds from investors, not raised money by issue of equity shares. They have borrowed funds from investors. Now, Zepto gives interest of 8% coupon rate. Okay. Zepto gives interest 8% coupon rate, and with that the price of the bond in the open market is 95 rupees. It is not listed on the stock exchange, but if anybody wants to buy a bond of Zepto or a debenture of Zepto, it is at 95. Now, you don't hold bonds of Zepto, but you hold bonds of Swiggy Instamart. Okay. You have given loan to Swiggy Instamart, and the coupon rate, that is the rate at which Swiggy Instamart is going to pay you interest on that borrowing, is again 8%. Now you are preparing your financial statements and you need the fair value of the bond in order to complete the preparation. You don't have the fair value because there is no active market specifically for bonds of Swiggy. But you know, maybe someone you know or someone in your family holds bonds of Zepto. The coupon rate is 8%, and when the coupon rate is 8%, if you observe, these two companies are basically operating in the same industry, which means their profile is similar. If Zepto ka bond with an 8% coupon rate is being bought and sold for 95 rupees, then Swiggy Instamart, which operates in the same business, is also offering 8% interest on its bonds, then it is highly likely that the fair value of one bond again is 95. We came to this conclusion based on two comparisons. We said these two industries are basically in the same space, and both these companies, when they are borrowing funds from investors, both of them are borrowing at the same rate. Okay. And now since both of them are borrowing at the same rate, we come to a logical deduction, a logical conclusion that the price of one bond of Swiggy Instamart is also 95, which is my third classification under my level 2 input, observable inputs other than prices. And the third one is your level 3 input. Okay. What is covered under level 3 inputs? This is now my least credible source of calculating the fair value. Level 3 inputs are basically unobservable. You cannot observe or touch or feel the level 3 inputs. But if you cannot observe, you cannot see, how can you use these inputs for determination of any fair value? Let's understand it from a slightly different perspective. Think about this blackboard, okay, which I'm using to teach. I want to calculate the fair value. There is no active market or less active market. There is no identical asset. I do not have a quote, but I want to calculate the fair value of this blackboard. Now, I know as much as anyone else that the value of anything is dependent upon the benefits I derive from that item. Why are you willing to pay 10 rupees to buy a Kit Kat? You are willing to pay 10 rupees because you feel that the benefit you get out of it, the utility you get out of that chocolate is worth 10 rupees, which is why you as an individual are willing to pay 10 rupees for a Kit Kat. Now, I want to justify the price of this. I want to calculate the fair value of this particular blackboard. I know that what is the maximum amount I am willing to pay for this. The maximum amount I am willing to pay for anything under the sun is nothing but the value of benefits derived from that item. How many times have you found yourself saying, I went for this film, but it was not worth it. The ticket price was not worth it. What does that mean? I paid 200 bucks, but the entertainment I got after watching that movie, after paying 200 bucks, was not the same. I want to know what is the value of utility that I get from this particular screen. Let's assume that I will end up using this screen for 3 years. Okay? Year 1, year 2, year 3. When I use this screen, I will prepare videos and I will sell these videos and earn income in the process. Say in the first year, I earn 20 lakhs. In the second year, I earn 35 lakhs. And in the third year, how much do I earn? I earn 50 lakh rupees. This is my projection. So I make a projection that I will make the videos, I will list it somewhere, and then people will buy the videos and they will pay me money. I have a very optimistic viewpoint that in the first year I will earn 20, in the second year I will earn 35, and in the third year I have a projection that I will earn 50 lakh rupees. Do I have any observable input? No, these are my projections. So what is the total value of benefit that I will get from the usage of this laptop? 20 lakh, then 35 lakh, then 50 lakh. But these are not coming to me in the same year. So if I were to add them in a linear manner, 20 plus 35 plus 50, I would get a number. But doing that addition does not make a lot of sense to me. And why? Because these cash flows are coming to me at different points in time, not today. If I have to calculate the fair value today at this point, what I need to do is I need to calculate the present value. Okay? I need to calculate the present value of this item. How do I calculate the present value? I will have to multiply this with an appropriate discounting factor. Say for example, my cost of capital or my hurdle rate is 10%. I will have to calculate and write down the discounting factor for each of the years. I write it down. I multiply this cash flow with the discounting factor. I aggregate it together, and that total is the present value of all future benefits I am going to receive from this particular asset. I will club it together and I will say this is my fair value. Fair value is nothing but the amount I would pay to amount that I would receive on transferring an asset to someone else. If I am transferring this hen that lays the golden egg, if I am transferring this asset to you, I would want you to pay me for the income generating capacity or the cash generating capacity this particular item has, which is the present value of all future cash inflows. And the reason I call it unobservable inputs is because these are projections. I do not have the actual numbers with me. And because these are projections, these are not actual values, they come under level 3, which means the amount of credibility that you can place on them is the least. That is why I call them level 3 inputs. If I were to write it the way you put captions on Insta, I would say 1 greater than level 2 greater than level 3. This is how the hierarchy of inputs is when you are calculating the fair value. Now, having understood fair value, let's spend some time we understood the price part. Now let us spend some time understanding how do the markets work. Which market are you supposed to look at when a fair value determination is happening? Okay. There are two markets that we are going to discuss. The first one is the principal market and the second one is the most advantageous market. Okay. So let me write down the first category, which is principal market. And this one would be most PAGEOUS. One market is the principal market. IFRS 13 says that mostly fair value should be calculated with reference to the principal market. And what exactly is the principal market? It is the market with the greatest activity. Greatest level / volume of activity. That is my principal market. So if I want to calculate the fair value of a share that I hold, it is a listed company, I will probably look at Bombay Stock Exchange. Why? Because that is the market where the greatest level or volume of trading activity for this particular share happens. Okay. And the most advantageous market, there could be cases where you do not have access to the principal market. See, just having a principal market is not enough. You should be having access to that market. Now, why is it important? Say, I know that when I have my output of Fafda, I can sell it the most in the state of Gujarat because that is where the greatest volume of transactions is going to happen. But maybe there are some, the road has been damaged and there is no railway connecting the two states, your state and that. You have an output of Fafda with you, but you cannot take it there because the road has been damaged, the railway network is not working, flights are not working. Because of that reason, although there is a principal market where normally the highest volume of transaction happens, still, because you do not have access to it, you cannot consider the fair value from the principal market. In that case, you will have to think about the most advantageous market. In case there is no principal market or access to principal market is not possible, you have to make a reference point to the most advantageous market. This is the market that maximizes the net amount received from selling an asset. Okay. So this is a market that maximizes net amount received. Net amount received after adjustment of transaction costs related to that. So we look at an example to understand how do you determine the most advantageous market and how do you use that as a reference point for calculation of fair value. Most advantageous market is that market you would fall back on in case you don't have a principal market or you do not have access to the principal market. The most advantageous market is the one which maximizes the net amount received. Let's understand that. Most advantageous market. This is the market which maximizes net amount received, which means from the focus is on the word net amount received. For example, I am a seller and I am trying to sell, say for example, earrings on different websites. I am trying to sell it on Amazon and I am also trying to sell it on Flipkart. Okay. These are two online e-commerce platforms. I want to know which of these is my most advantageous market. Okay. My selling price is 50 and on Flipkart my selling price is 49. Okay. I have to maximize my net amount received. So from this I will subtract transaction cost. Maybe these are charges for listing this particular item, or these are certain additional charges that you have to pay to make the sale of this item possible. Say for example, the transaction cost here is 3 and here it's 1. Okay. What is the net amount received? If I sell it on Amazon, the net amount received is 47. If I sell it on Flipkart, the net amount received is 48. Now, which is the market that maximizes my net amount received? It is Flipkart, because the net amount I receive here is more, 48. So, Flipkart is my most advantageous market. So, when I have to make a reference to fair market value or a fair value, I would go to 49 and call this my fair value in wherever there is a reference to fair value, I would use 49 and not 50. See, if you observe, the gross amount of Amazon is more. This gross amount of Amazon is more as compared to Flipkart, but the most advantageous market, it tries to maximize the net amount, and net amount is more when it comes to Flipkart, which is why Flipkart is my most advantageous market. And now when I have to give a fair value reference, it will be for 49. Okay. So you have to understand that when I'm thinking about price, I go for level 1, level 2, level 3 inputs. Then when I want to understand which market should I take the value from, I have to go to the principal market. If the principal market is not there, or I do not have access to that market, then I should fall back upon my most advantageous market, and this is the approach I have to take. Now there's just one part that is left in IFRS 13 discussion, and that is non-financial assets. Okay. Non-financial assets. Now, most assets or all assets that we know can be split into two categories: financial assets and non-financial assets. Financial assets as a discussion point is a separate chapter altogether under financial instruments. We'll come to that later. Right now, when I'm talking about non-financial assets, let's try to understand what falls under this particular category. Items like your property, plant and equipment. Items like your intangible assets. These fall under the category of non-financial assets. Financial assets are your investment in equity, investment in debt, your cash, your receivables. All of these fall under the category of financial assets. Property, plant and equipment, intangibles fall under the non-financial assets category. Now, what does IFRS 13 say with reference to the calculation of fair value of non-financial assets? It says that the fair value of a non-financial asset should be based on highest and the highest and best use. Now, what do you mean by highest and best use? If I have a premises located in Mumbai, and this premises, if I give it on rent to a commercial developer, I will derive an annual rental of 10 crores. If I allow it to be developed as a residential property and give it out on rent, I will get an annual rental income of 8 crores. Now, the highest use and the best possible use of that premises is if I convert it into a commercial premises and rent it out for commercial purposes, I am getting a higher value, which is why the commercial purpose is my highest and best use, and that should be considered as the basis for calculation of fair value. Okay. Now, the highest and best use should take into account uses that are physically possible. Okay. Physically possible. Then it has to be legally permissible. I mean, you could go to the extent of saying that if I convert this particular building into a residential apartment for residential use, I could get 15 crores worth of annual rental. But given the area that this building is located in, the government authorities will not grant you the permission to convert it into a residential premises. In which case, although it is physically possible, it is not legally permissible to make that particular change. And last thing is financially feasible. say for example, we talk about the same building that I can get permission from the government authorities to convert the utility of that into a residential usage, but it is not financially feasible in the sense the cost of applying for permissions, the cost that I would have to incur to convert it into a residential building is far too high as compared to the benefits I will derive out of it. So, while it is physically possible and legally permissible, it is not financially feasible. ठीक है